Hi, I'm Keith McCullough. I'm here with Tom Tobin, who's a senior partner at the firm who runs our healthcare team. And I wanted to talk about a macro topic with Tom that's more healthcare oriented that got our attention the other day. So welcome, Tom.
Thank you. Good to be here.
Just wanted to get into this headline, which we're going to put up here. Over roughly 3 decades, we provide evidence that daily fluctuations in stock prices has almost immediate impact on the physical health of investors.
Yeah, it's a fascinating study. This fellow at Bloomberg, Jeff Kearns, put up this article on Sunday night, which I read, and it was interesting to me, which grabbed my attention, was as it relates to a relationship between confidence and medical consumption, which I've been noticing in our data sets for some time and largely ignoring because it seems so loosely connected. It's not income, it's not your net worth, it's not any of these other medical-based things, but it's literally how you feel.
Loosely connected, but once you read it that plainly, it is intuitive.
What they found in this study is that they studied 30 years of daily hospital data, and they related it to the stock market trend locally in California. And what they found was on days of big drops in the stock market, you saw a subsequent 1, 2, and 3 day rise in hospital admissions. And it was controlled for all sorts of other things.
So basically, scary.
It is scary. I mean, both for behavioral health stuff, so people having deep anxiety attacks, but also having heart attacks and all sorts of other things. But the point is that this idea that confidence is linked to going to the mall, like I think healthcare investors largely have been looking for a recovery in medical spending. And when they haven't had it, you've seen people go back to the mall, but maybe that's just it, that a healthy, like a confident consumer is going back to the mall, but when they're feeling badly, they're heading to the doctor's office. It may just be that simple. But again, it's something that we've seen but not necessarily emphasized. And what I've done, this report we put up was United Healthcare's medical cost trend looks highly correlated to year-over-year change in confidence.
That's an interesting one. I mean, if you look at this and just flesh this out a bit. So this shows UNH, United Healthcare, utilization versus U.S. consumer confidence as measured by the Michigan survey. What does this utilization word mean, by the way?
So utilization. So an insurer collects a premium and pays for all the costs of the insured people in the plan. Right? Okay. So they fix premium, flexible costs. If people go to the doctor more, the insurance company makes less money. If they go less, the insurance company books that as gross profit. Okay. So in this scenario, what I've done is backed out using their filings, their data, to back into what is actual utilization trend in their book of business. This is what I've done is adjusted their reported numbers for inflation, which is a basket we've created, get into their utilization factor, and I have a large database of other factors. So I'm overlaying the inverse of changes in confidence with the year-over-year change in utilization.
So this really fits the survey like a glove. I mean, they're inversely correlated, is what we would say.
Yeah, like confidence goes down, utilization goes up.
Now, another thing that at least people who follow us at Hedgeye would be looking for here is some kind of a multi-factor analysis. So if you kind of like take that underneath the hood and you do this great Big Mac analysis of different factors in macro, what else can you kind of glean or how do you even think about it that way? Do you just start to say, oh, and this and that, because I've been looking at this over the years?
Yeah, so healthcare is complicated and things take a long time to develop. It moves really slowly, sometimes to the point where you can't see the change happening. Surprises happen sort of episodically and catastrophically. Oftentimes things are very surprising to consensus, or I think more so than in other groups. Within United Healthcare and the other managed care companies, what's really interesting is there's so many parts of the puzzle to figure out. So within cost trend, you've got all these different types of consumers. You've got people in their 80s on Medicare. You've got people in their 20s commercially insured who don't consume anything. Then you've got all these other people in between with different pocketbook issues, with different just pushes and pulls on their P&L.
Yeah, huge.
And how they consume medical care is wildly different between your 20s, 30s, 40s, and et cetera. So what I've done is really try to hone in or focus in on what is it in this basket of people. What do they consume? Well, they consume largely inpatient care. That's a big component. They go to the doctor. So we run a survey every month looking at physician visits in a commercially aged population. I look at knee and hip trends, particularly on the knee side. I look at cardio growth. So there's probably upwards of half a dozen to half a dozen of individual items that I'm really studying or looking at or considering in the constellation of all the other things that are going on.
And that's I mean, it's a great way to kind of summarize that. So you can see things like spine, year-over-year growth in spine that Tom's talking about, or knee replacement surgery. But you also have, you know, change in the S&P 500, change in the VIX.
Well, and again, I've added that because this Parsons study tells me that the stock market actually matters.
Well, it does. You know, it makes sense. I mean, it's almost like when you said, you know, healthcare occurs episodically. I mean, it's almost like investors in the world of healthcare, you know, their world is based on episodic, coincident, and leading indicators as well.
Well, the changes come slowly, and when finally you get the reveal, it's usually not a good update. It's the kind of thing where, because the other coincident problem that's going on in the managed care space is that as cost trend has slowed, as medical cost trend has slowed, they're pricing down to this trend. So their premium dollar that they're collecting per member is slowing, and it's not shrinking, but it's pretty much close to 0% growth. Mm-hmm. They're baking in a certain amount of negative doctor visits, hospital visits, et cetera. They're banking on the idea that this utilization trend that we've seen for the last 6 years continues. Mm-hmm. The problem is that if it doesn't, right, you're baked in at a fixed price, cost trend picks up, you know, the gross margin impact is
this
severe
is what
negative.
makes this call so interesting, because particularly for a stock like UNH, like Deutsche Bank upgraded UNH today, they're basically depending on the opposite of what you just said.
It's very easy to say anecdotally what you see in the constellation of news flow. LabCorp pre-announced poorly. That's a big Medicare business. They're also exposed to PAP, which has had a huge headwind. Community Health put up just a terrible volume number today. They were banking on 3 to 4% down. They said it's going to be, I think, -7 or something. So the trends are negative. The point is, within that basket of trend, it's flu, which doesn't pay very well. It's down 22% year over year. Births.
Doesn't pay very well. When Tom says doesn't pay very well, if you go to the hospital with flu or to have a baby, that doesn't pay well. In other words, you don't make a lot of money as a hospital.
From the hospital perspective, it's a very low pay, low margin business, but it's a big part of your business. Mm-hmm. So the volume can get hurt quite a bit, but your EBITDA dollar value doesn't get hurt that much.
So in other words, Community can come out and say our volumes are down 7, but our profits aren't hit that badly because we weren't doing a lot of flu, we weren't doing a lot of babies.
And that's exactly what they said. So they pre-announced a bad volume number, but they gave guidance for 2014 that's basically in line with what consensus is. Mm-hmm. So it wasn't, how do you make money at down 7% volume? You make money down 7% volume if your ortho cases are up, if your cardio cases are up.
Because that's the high margin.
That's the high margin.
That's why you're tracking things like knees, spines, everything else.
Yeah, if you look at the basket of stuff in the inpatient setting, which is the vast majority of cost trend that UNH pays for and the other managed care pays for, there's about 15 to 17 codes, meaning procedures, that make up about half of the total cost trend. The vast majority of them are ortho. Like number 3 is spine. It's knees, it's catheterization, so people get some sort of heart procedure, but it's basically these 2 buckets. So now that I understand that it's mostly 15 to 17 codes, I just focus on those to understand the global trend. I can kind of ignore a lot of other data sets that seems to be sort of the anecdotal truth of cost slowing.
That makes a lot of sense. And that's why we do macro that way, and particularly why Tom and I have so many good, interesting discussions throughout the day, because we talk about a lot of factoring, a lot of behavioral and historical overlays that Wall Street we don't typically see talk about. So that's that. If you have any questions, again, it's Hedgeye Playbook. Tom and I have worked together for a long period of time. History, math, behavioral, it's all there in terms of what we're trying to really analyze here when we make calls on both the healthcare sector and stocks within that sector. If you have any questions, I'm at Keith McCullough. That's my Twitter handle. And Tom, you can find him, his Hedgeye healthcare handle is Hedgeye HC.